You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
Welcome back to Options Insider Radio, the interview program here on the old network where we welcome on guests from throughout the world of options and derivatives and proceed to pick their brains for the benefit of you, the listener. My name is Mark Longo from the optionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. If we sound a little bit different, it's because we're not coming to you from our studio in Chicago. We're coming to you from the Options Industry Conference here in sunny Florida. And one of the great things about this event is it gives me a chance to catch up with a broad cross-section of the industry. And one of our next guest is an old friend of the network, even though he hasn't been on in a while. He's been up to a few things. He is Andy Nybo, a director over there at Burton-Taylor International Consulting, a division of TPI. That's quite the business card you got. Does it fit in your pocket there, Andy?
Thanks. Good afternoon, Mark. Thanks for having me on. Yeah, it fits in my wallet, frankly. So it's a great opportunity. I joined Burton-Taylor about a year ago now, and I've been exploring a new area of the world, market data, and how that works within the capital markets, global capital markets industry, as well as the derivatives industry here in the U.S.
I could have saved you a whole year worth of research on market data, Andy. Market data is too expensive. That's it. That's pretty much all you need to know, right? That's you mentioned market data. Just about anybody outside of an exchange who provides it, it's too expensive. That's the one refrain we hear from everybody. So there you go. I saved you a year's worth of work. You're welcome. But I'm joking aside. Tell us a little bit about, obviously you used to do a lot of market structure, options market structure in your previous gig over there at TAB. Tell us how that you parlayed that into what you're doing over there now at Burton-Taylor and kind of what this market data research entails.
Sure, thanks. And so I've been in the business for quite a few years. Prior to my old position at TAB, I was always on the research side, fixed income markets, equity markets, derivatives markets. And over the years, I've learned a lot about the industry, a lot about market structure. And this opportunity arose. It was around market data, around the exchange industry. And it gave me a chance to kind of take all that knowledge I've learned over the years and use a market structure overlay and kind of look at how market structure is evolving and how that's impacting the market data industry, the business model of exchanges, and really kind of explore new types of ideas and new areas of research that kind of expand my coverage area.
So tell us a little bit about that. Don't give away the golden goose, obviously, but give us some of the areas some of the interesting new findings you've discovered when you're digging into market research over there.
Sure. So, you jokingly talked about market data and the cost of market data. One of the things that is very apparent in the industry now is there is so much market data out there. There's so many different types of things that you can look at, that you can analyze, that you can incorporate into your trading models. And of course, the costs of market data are seemingly rising on a daily basis. But also the value you're getting for the market data you're buying is incredible. And part of the challenge that the exchanges face is they're constantly being asked to provide more data, new ways of looking at data. So their business model is to answer client demands, and one thing they're doing is providing new types of data that can help inform their clients' trading decisions. We have a number of exchange clients, and they came to me and said, you talk about all the different types of data that we provide, whether it's index data, reference data, real-time data feeds. One of the challenges we face is everybody puts the concept of data under one category, market data. We really provide information, and we have an information services division. The cost of information is constantly growing, but you're also getting much more for that spend. So as exchanges report their results every quarter, one of the biggest and fastest growing segments at exchanges is information services, because they've found that they can leverage their data sets and leverage their client base to grow that source of revenue. One misconception, it's not all real-time market data feeds that are constantly being jacked up in price or more exclusive over time. They're providing all kinds of data services, all kinds of market data, reference data, index data. So it's not just market data, traditional, the view of market data as real-time market data. It's a whole suite of products that they're offering under that mantra.
It's interesting. I hadn't thought of that approach before, of kind of siloing off or putting different buckets in the market. You're right, because we just say market data. We don't really think of it beyond that, but there's real time, there's close to close, there's a lot of these, at a conference like this, you see a lot of enhanced data feeds, so they're pushing not just the prices, but analytics, the Greeks, volatility, and a lot of cool things are going down that dumb pipe. So you're right, maybe lumping it all, maybe we do it a disservice, lumping it all together as, see, you taught me something already here, Andy. Just, it's still too expensive, but at least I have a better appreciation for the different buckets and what they should cost.
Yeah, I mean, one of the reports I'm working on now, that it looks at the market, the exchange industry, looks at the top 15, 20 exchanges in the world, segments how they generate revenues and where they're seeing growth. And part of that is information services. The next kind of major report after this is actually looking at exchanges and dissecting their information services businesses to identify where they're seeing the growth, where they're raising revenue, and where that kind of value for the dollar is really coming from out of exchanges.
It's interesting you mentioned that, because there's probably more demand for your area of research now than ever. I mean, we've seen a lot of big exchanges like CME have some problems in the market data division of late. Some of that, I think there a couple of earnings reports, they cited market data as being a bit of a laggard, and that's kind of dragging down the whole. So do you think maybe, have we reached peak market data? Are we there? I mean, has it gotten to the point where it's so ubiquitous, so expensive, as I mentioned before, there's so many different varieties of it that even a big entity like CME can't make it work to the degree that they want to?
I think CME is a unique case. If you look at the segment of the industry, the segment of the derivatives industry that CME is involved in is, the futures industry. Primarily, they're a futures exchange. That industry has changed dramatically in the past several years. It's gone from a very large industry, lots of futures commission merchants and lots of screen traders, to a much more electronic marketplace with fewer firms involved in the industry, and quantitative trading is a much bigger part of that trading engine there. So as their industry, as their user bases transition from screens to a more automated trading function, as well as a fewer number of FCMs, their user base has declined, and therefore their revenues potentially have declined. I'm sure with their announced acquisition of Next, they've got new ideas and new ways to perhaps expand the types of data services they provide to their clients. So maybe we'll see a return to growth after they close on that acquisition. Globally, I think, I don't think we've reached a saturation point. I think the need for data continues to grow. As I mentioned before, everybody seems to equate, the concept of data to support trading decisions with real-time trading fees, which is just one part of that kind of input into trading strategies and engines. I think where we're seeing, and potentially we'll see further growth, is continued layering of analytics on top of existing products that they provide. Technology is evolving to the point where now delivery mechanisms are changing dramatically for just about any firm that consumes data and consumes lots of data. It'll be data on demand. It'll be cloud services on demand. We talk about, build your own platform, buy a platform, lease a platform. Well, I think we're getting to the point now where you have timeshares of platforms and timeshares of market data as you go along. And when you need a certain set of data, you want to get a certain time period and perhaps use that to gain as much edge as you can. It's going to be a much more short-term time period. You're going to use that data. Consumption period will be priced accordingly.
Now, we've seen obviously a lot of evolution, as you mentioned, in the market data space. Do you think we've seen a commensurate evolution in trading, maybe as a result of the evolution of market data, where, as we mentioned before, kind of the costs have, particularly for that bleeding edge, low latency, up to this millisecond type of feed, as the costs for those have just grown exponentially. Have we seen kind of a little bit of a shift in firms maybe changing to a little bit less latency sensitive? Just doing that alone could have a data arb effect on their profits. Have you seen the resulting changes like that in the space from the trading firms responding to this ever increasing overload of data?
Yeah, I mean, 5 years ago, 10 years ago, it was an arms race. It was a latency race. Let's minimize that latency, and we can get an edge. We can get an advantage over our competitors. I think that the latency race is nearing its end. I don't think the value of an additional millisecond or microsecond is really there for the investment. So I think consumption of market data is getting smarter. I think firms are looking at market data. They're looking at different sources of data and examining what kind of edge they can get from consuming that data. So they're being smarter about their data purchases. They're being smarter about how they consume it, where they consume it, and what they use it for as well.
We're obviously here at the Options Industry Conference. So options data, kind of a unique beast. Some people, I've often referred to it as like the fire hose, the full monstrosity that is opera, and just how overwhelming that could be to a lot of firms. Maybe they're coming from the stock world and they're not used to. They're used to just getting a Google feed, not just Google with thousands of series on months and strikes, let alone puts and calls. It can be a bit overwhelming. Have you seen that in your research these days as well? Like the unique needs and challenges of options data versus, let's say, traditional equities or some of the more Delta One type products, and are firms maybe shying away from getting into options, perhaps as a result, because the data feeds and not just the cost, but managing and being able to parse and use that data is just so overwhelming that they'll stick with stocks?
No, I would argue it's more demand driven. So if your user base, if your clients, if the end users of the data are demanding it, then as a vendor or provider or a broker will deliver that type of data and find a way to deliver the data. I mean, if you look at some of the leading e-brokers or the brokers catering to retail investors in the U.S., they're seeing tremendous growth in mobile trading. But delivering the market data, the options chains, the ability to pull up on a phone, the current price for a derivative 2 months out, 1 week out, 3 days out, for a lesser traded option, and get that real-time data quote montage on your mobile instrument is incredible. And being able to do that involves scale. It involves the ability to kind of monetize your customer base and allow them to have access to that data. If you have a small user base, maybe it doesn't make sense to go that step. But as firms get larger, as their customer base grows, and as they can develop scale in their activities, they will invest that additional resource into providing that data feed. I think the arms race is not only about speed in the more institutional segment or the market making segment, but it's also about technology. So all facets of technology are critical to being able to participate and be active and profitable at the highest levels in this industry. So the market makers are spending 30, 40, 50 million on technology alone. So there are barriers to entry. So a new market maker looking to come into this industry has that technological barrier, they have that capital barrier, and the regulatory barrier to kind of enter. So I think it's the data, the amount of data, the fire hose of data that you described is part of the challenge. But I think as you enter this industry and as you're successful in this industry, it's a matter of scale and being able to manage those huge data sets.
Yeah, that's one of the challenges, like you mentioned. We've been talking about that a lot at this conference for the various guests, just how challenging it is to become a market maker. Like you alluded to here in the space, there are pretty much, you can count most of the big ones on one hand these days who are left in the space. And that's obviously an issue. We're seeing kind of the ramifications of that playing out. A lot of talk about liquidity here at the event. In fact, we polled our audience before we came down here. We said we're doing our big OIC roundup, what should be top of mind for us when we're talking to various people in the industry, and over half said liquidity concerns were top of mind for them. So it's kind of interesting. I know you spent a lot of time in market structure in your previous life before segueing off into market data. What are your thoughts on kind of liquidity concerns? Because, we've seen the data here every year, somewhere around 20 names doing like half the volume in the option space, and that the trajectory isn't going in the right direction for that. What are your thoughts on liquidity issues here in the option space, and maybe what we could do to address that?
Sure. So I think liquidity challenges are a multifaceted question that needs to be addressed. And I think it's partly the way the exchanges have built their market models, the auction environment, perhaps is internalizing volume and keeping some of the screens from being lit. I mean, liquidity is an interesting concept, right? What is liquidity? Is it liquidity on demand? Is it size? Is it at a point in time? So there's a lot of different definitions. I mean, the U.S. options markets have traditionally been, or have transitioned to the screen-based system where you can see type bid and offers. Unfortunately, over the past 5-10 years, you've seen that those type bid and offers concentrate in those most active names. So it's larger cap names where there's a lot of demand, where there's weeklies or short-term options on those companies. So the demand is focused on the bigger names. People are more actively trading those names, the FANG names, the larger technology companies. So where there's demand and where their interest in trading the underlines, it also has translated into the options on those companies. So it's a challenging facet of the market that we need to address. But it's not going to change overnight. I think the structure and the protocols and the trading strategies of the exchanges and what they offer to their client base, the market makers and the dealers and the broker dealers, has contributed to the kind of concentration of liquidity. I think the shorter term expirations in those names as well has also contributed to that liquidity concentration. But again, that is user demand. That's demand for those shorter term expirations that investors can use to protect, to speculate into time market events that are coming out, whether it's earnings or a corporate event that may impact the price of the stock.
You mentioned the auctions. That's a very divisive topic. We have a lot of guests through here, and it seems like there's a pretty strong schism. Some people think they're great, or at least maybe they were great when they were first conceived as some sort of protection for the market makers, as well as to get a little bit better price for the retail. So makes sense, sounds good. Other people are thinking that, like you were just illuminating there, that this is caused a lot of the issues we're seeing right now with displayed liquidity decreasing. And after all, if you're a market maker, if you don't have to show your best hand, why would you show your best hand, right? You have an incentive not to. So it sounds like, I think I can intuit from what you just said, that you're not a huge fan of auctions, but what are your thoughts in general on kind of just the growth, the explosion of these PIP mechanisms and their various incarnations, and maybe some of the unintended consequences that we're seeing now in the space?
Right. I wouldn't say I'm not a fan of auctions. I think they've created a very valuable tool for the retail investor to get a great customer experience, great pricing, and price improvement when they have those small lot orders. And one of the unintended consequences is a bifurcated market, right? So all the good flow, all that valuable, edgy flow is going into the auctions. The majority of that flow is from the retail investor, and the more toxic, less edgy flow is not going in those auctions. So it's you have a two-tiered or multi-tiered marketplace that's developed. So there's good and bad with any market development. I think for the retail investor, they've been fantastic. It has definitely changed the way orders get to the market, the way consolidators operate, the way the brokers route order flow.
I don't think I'm legally obligated to let you come through here at a conference like this, Andy, without asking you about the proliferation of exchanges. We are on the cusp of number 16. I think MIAX is talking something around Q1 2019, if all their I's are dotted or T's are crossed on their proposal. What are your thoughts, again, as an old school market structure guy, on this just continued addition of trading venues, and again, maybe some of the unintended consequences we're seeing now with displayed liquidity, maybe being fragmented a bit as a result?
I think it's fantastic because it's given me an opportunity
it's good
great for my
business.
business. So,
we want 100 for Andy here.
Exactly. And, the complexity that arises, the incremental complexity of one more exchange is I would argue, is not that big a deal. However, when you have an incremental increase of one or two exchanges over time every year, you create this complex market fabric that does raise costs for the industry. Connecting to each new exchange, providing access to each new exchange, managing the data that's produced at each new exchange. The regulatory function that is coming with each new exchange, each new medallion, does add costs to the industry. It also adds user choice. It offers new protocols. I was on listened to a panel before, and Shelley Brown from MIAX was talking about how their approach to creating their exchange, and now their multiple exchange, and their third one will be in spring of 19. They've raised the bar from a technological perspective, right? So that brings up the whole marketplace and innovation from that perspective. But I would argue that more and more exchanges over time does raise costs for the industry, and kind of is a challenge that everyone faces. I think the consolidation we've seen with NASDAQ acquiring ISE and their 3 exchanges, and the merger and acquisition of BATS by SIBO has brought 4 medallions under the SIBO nomenclature, and NASDAQ now has 6, and MIAX will have 3 shortly. I think that does help the end users in the broker-dealer community, because it tends to have the similar technology platform and trading or connectivity protocol for those 6 licenses as NASDAQ or 4 at SIBO. So that, to some extent, that does make it a little bit more palatable for the brokers and for the market makers. The challenges with 16 different venues or 15 now, the market makers are having to manage risk across all those different platforms. So that does raise concerns, and that does raise costs for the market makers. And they have to determine where they want to participate and their risk exposure across all those exchanges. So it does, raise some questions and fears around that part of it.
Well, Andy, I'm glad we can get you back on here to check in. It's been too long since your last appearance. We'll have to do it more frequently than once every 2 or 3 years like we've been doing it lately. But before we go, if there's any interesting research or projects you have coming up that you think may interest our audience, maybe I'll leave them a little bit of a hint, a little bit of a tease of what you're working on, in addition to your Market Data is Too Expensive report, which I know is forthcoming. Now is the time, sir. The floor is yours.
Sure, thanks. We've got a couple of projects that are relevant to your audience, and in the near future, in about a month or so, we've been working with the OIC on looking at European demand for U.S. options, so order flow coming from Europe, looking to get exposure to U.S. markets and use U.S. options in their trading strategies. That's forthcoming.
So you're still doing some of your old market structure
absolutely,
stuff then, too?
Yeah.
Okay, you're not just purely in the market data weeds.
No,
okay.
Absolutely not. And the other project and other report we'll be coming out with later this year is we're looking at U.S. options market structure and these exact challenges that you brought up with 15, soon to be 16 exchanges. We'll be looking at all the exchanges, what their business models look like, what they're generating in terms of revenue, how much revenue they're generating from trading, from market data, or from other services. So it'll be a deep dive into kind of the business model of options exchanges in the U.S.
That'll be fascinating to see, because you see, you mentioned, they're lighting up these exchanges. Most of them are sub 1% market share. The question we always get is, how are these economically viable to do? And usually the answer is the costs are just so low that it's a low cost issue. But we never really see, the revenue side explored of, what is that 0.8% market share really translate to in terms of revenue, and what are you actually getting out of that? So I'll be looking forward to that one when that one comes out, to bring you back on to talk about that. Well, Andy, it was great catching up with you, and good luck with this. Not quite new, you've been there a year, but a new venture nonetheless, and we'll look forward to seeing how all of this research plays out in the marketplace in the coming months.
Well, again, thanks for having me. I really enjoyed being on your program.
Great, thank you.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions@theoptionsinsider.com.